In the previous video, we began the discussion of FinTech by pointing out that the field of financial services has always been linked with technology and innovation, dating back to early civilization. So if that's the case, why do we need this new terminology, FinTech or TechFin for that matter, to describe the present day? What's so different nowadays to have generated so much buzz and to be receiving so much attention? The critical difference lies in the fact that over the past 15 years or so, financial services innovation has taken a significantly different path than before. And the reason for this is who's leading the charge. Historically, financial institutions, the banks, the investment managers, the hedge funds, have been the pioneers in most technological innovations, from money to cheques, to credit cards, to ATMs, to online trading and so on. Recently, however, it has by and large been the technology companies who have been breaking new ground. For the first time in history of the financial services, we are seeing companies like Google, Amazon, Facebook, companies we don't think of as financial institutions, and when compared to the incumbent establishment, didn't even exist 5 minutes ago. We see them beginning to take on core financial services functions right across the financial landscape of transferring, raising and investing money and capital. This is partly because of the big data boom and technology companies having hitherto unheard of levels of access to consumer data, and partly because technology companies are not subject to the same regulatory stringency that financial institutions are. As a direct result, they can afford to be significantly more aggressive in taking on risk, in developing new products, new technology and opening new markets. This has led to a situation where traditional financial institutions are in danger of being left behind on many technology fronts by companies who have never even done finance before. To give a concrete example of the kind of FinTech evolution or revolution we are referring to, we can take a look at how some elements of the UK payment system have evolved even in the last few years. The simple example which follows is part of a deeper transition whereby many existing financial services practices are being taken from a yesterday business model, one based on people, paper and buildings, to a tomorrow business model, one based on data, software and servers. Enter the humble paper cheque. The process and procedure for clearing cheques had changed very little in a century. Indeed, so antiquated had the use and process of writing and clearing cheques become that in 2014 there was serious consideration given to phasing cheques out altogether. Alas, the introduction of ICS, or the image clearing system, has given the paper cheque a digital stay of execution. But until just a few years ago, the process which took place from the time an individual wrote a cheque to pay for something until the money behind the cheque ended up in the bank account of the intended recipient was pretty convoluted. That little paper cheque often went on a physical journey along the road in the back of a van or on a train or even on a plane to get to somewhere where it could be checked by hand, and then eventually on to the issuing bank where further checks and authentication took place before the money ever changed hands. To illustrate this, let's suppose someone has just written a cheque, perhaps to pay for some goods or a service, or to make a donation. Most people don't give much thought to what happens next, but what happens next actually serves as the backbone upon which many new innovations are built. It is easiest to represent the technical underpinnings in a diagrammatic setting. The payer writes a cheque to someone, the payee. In order to do that, the payer needs to have a current account with a bank, or some form of bank account upon which cheques can be drawn. After the cheque is posted or handed over and the payee gets it, they're going to deposit it at their bank or with a third-party cheque cashing facility, which in turn will deposit the cheque with their bank. In any event, the cheque ends up in the possession of a bank at the receiving end. Now this is when the interesting stuff starts to happen. The receiving bank will inspect the cheque and identify the payer using two numbers printed on the cheque. the sort code number, which identifies the payer's bank, and the account number that the payer has with that bank. Based on this, the cheque is going to be routed back to the payer's bank through a centralised cheque clearing system, sometimes operated by a country's central bank. In the case of the UK, the system is operated by the Cheque and Credit Clearing Company. The cheque is finally directed via the clearing system to the payer's bank. To recap, the cheque processing system has 5 important players: the payer, the payee, their respective banks, and the cheque clearing network, which serves as the central conduit along which the information embedded in the cheque flows. This is followed by settlement process, where money actually changes hands. After the payer's bank receives the information, they will complete some verification tasks to make sure that the payer does have an account there and that there's enough money in the account to cover the amount of the cheque. Once verified, they will send the money to the payee's bank, again routed through the cheque clearing network. Settlement finally occurs once the money is in the payee's bank account, and that's when we label the cheque as cleared. If everything is done using paper, as was the case until quite recently, then the whole process could take upwards of a working week, because the paper cheques had to be physically moved through the system. Overall, this sounds rather complicated, and I have spared you much of the finer detail. Given the complexity and relative inefficiency of the cheque clearing system, it is worth pausing a little to remind ourselves that this 300-year-old innovation actually has major advantages relative to cash payments. Notice the 2 types of arrows in the diagram. The green arrows represent the flow of information. In this case, information physically embedded in the cheque. The red arrows represent the actual flow of money during the settlement process. The crucial innovation compared to cash is that the flow of information is not synchronous with the flow of money. Essentially, by getting a cheque, you're getting information that you will be paid before you're actually paid at settlement sometime later. This time separation was a critical development, because if you have some trust in the system, then as a seller, you can deliver the goods once you get the information and trust that your money will come later. This enabled transactions to happen much faster, in much higher volumes, and over geographical area not practicable in cash transaction. The key feature here is trust, and that's where financial intermediaries like banks come in, because the very same time lag between the information flow and the money flow that constituted the technology innovation in the first place is also a critical limitation of the checking system. The existence of a time lag allowed fraudsters to take advantage of the system. Someone could write several cheques in different shops, receiving goods in each shop. The merchants have no way of telling that this individual doesn't have enough money in their account to cover all the cheques they have written. Unfortunately for the merchant, by the time they find this out, they have already handed over the goods. In many respects, this characterises the weaknesses in the people, paper, buildings, payment systems of yesterday. It seemed to be finance or technology. Many of you will have heard of PayPal, now a household name in a FinTech context. They are responsible for developing the original digital wallet. Ironically, in the early days, PayPal patented technology, the bits that worked that is, from a failed electronic cash system from the mid-90s. Owners of a PayPal digital wallet can transfer money from their bank account into the digital wallet account, after which transactions can take place between them and other wallet holders, including merchants, without money actually changing hands. A single line of code on a PayPal server executes to establish the fact that the virtual balance of say £100 that used to belong to the payer now belongs to the payee. PayPal's operation piggybacks on existing banking payments system and could not function without it. However, operations are completely decoupled from the banking system once money is transferred into the digital wallet, and for as long as the balance remains within the wallet. Of course, the owner of the digital wallet can withdraw their balance back into their bank account at any time. Within the wallet system, virtual money is transferred in real time, in other words instantly, and free of charge for most users. A free service for consumers, paid for through a fee-based business model for merchants. Digital wallet transfers are facilitated by more user-friendly identifiers, such as mobile numbers or email addresses, instead of needing to use branch sort codes and account numbers. The technological aspects are surprisingly simple. Again, it is helpful to represent this process using the five-party diagram, with the sender and the receiver, or more formally, the payer and the payee respectively, their banks, and the conventional payment rails operated by the banking sector. Now, let's give PayPal accounts to both the payer and the payee, which will be linked to their respective mobile numbers. In this case, we're going to need another bank account, one for PayPal. This bank account will serve as a central conduit for money flow in the system. Note that PayPal, like most other digital wallets, is not a bank. They don't want the increased regulation associated with becoming and operating as a bank. This being the case, in order to be able to legally hold your money, PayPal has to first partner with a bank and set up an account there. Now, to put money into the wallet, say £100, the PayPal app first authenticates the user and the request, which can easily be done biometrically. This initiates an ACS pool transaction that transfers £100 from the sender's bank account into PayPal's bank account. ACS stands for the Automated Clearing System, which is a term we shall use to collectively represent the existing payment systems in the UK. Now, although this is PayPal's bank account, they cannot touch the money in it, for instance to invest it. It simply holds that £100 as a custodian on behalf of the sender. That amount will be linked to the sender's PayPal account, showing up as a £100 virtual balance in the wallet. If we pause and briefly review the steps here, so far money has moved along the existing payment rails. But now that it is in PayPal's bank account and designated to the payer, the information flow, which is now in the form of virtual money balances within PayPal, is decoupled from the traditional ACS. If, for instance, the payer wants to send the £100 to another PayPal user, they simply put in the payee's identifier, the linked email address or phone number, and the virtual balance can be transferred instantly. On the back end, PayPal does not actually have to move any money. A single line of code in the software will reassign this £100 from the payer to the payee. The payee can keep that virtual balance in their digital wallet and use it to pay for something else or send it to someone else, and the code-based wallet reassignment process will repeat. Or they can decide to withdraw the balance from their PayPal digital wallet, converting the virtual money back into real money in their bank account. The withdrawal process occurs again along standard ACS payments rails, from PayPal's bank account to the receiver's bank account. Settlement, depending on some ACS specifics, may be same day or next working day. This example helps us see the key distinguishing feature of digital wallets. Money flows on the original payments rails as usual. Banks in this setting are doing what they're best at, moving money from one account to another efficiently and securely. Information flow, on the other hand, is decoupled from the traditional rails and predominantly managed within the digital wallet application. As long as it's within the wallet ecosystem, virtual balances can be moved around instantly and freely and used just as money. This innovation enables the digital wallet provider to facilitate economic transactions without becoming a bank. The tech innovators are doing precisely what they do best, taking on tasks like information processing and basic authentication from the banks. Rather than attempting to revamp the entire payments rail, it is much easier to improve the efficiency of these processes with incremental technology. In many regards, the digital wallet characterizes the payment systems of today. Here we have finance and technology. The planned future of payments in the UK has the potential to be a textbook example of FinTech. Some highly innovative national payment systems are already in place globally, such as India's Unified Payments Interface or UPI. At present, the UK has 6 distinct payment schemes. We have the BACS system, which processes the vast majority of salaries and benefits payments. We have the Cheque and Credit Clearing Company, responsible for managing the clearance of cheques and other paper-based payment instruments. We have CHAPS, the Bank of England managed interbank intraday payment system for high-value, time-critical payments such as property purchase transfers. We have Faster Payments, which, as the name suggests, is designed to move money around faster than, say, the BACS system. It tends to be used for transfers which are deemed time-critical but not necessarily high-value. We have PayM, the UK's mobile payment service for participating financial institutions and their customers. And we have Link, the network operator of the vast majority of ATMs in the UK. Now, these systems are well regulated. They are in general highly dependable and pretty efficient in their own right. But as a national payment system, they are fragmented, and there are clear benefits in bringing them together as much as possible under one scheme. That scheme is being referred to as the new payments architecture. This is very much still in development, so we do not know exactly what the finished product will look like, but my guess would be to liken it to a national rail system for payments. The tracks will be the telecommunications network already in existence, upgraded and updated in a more joined up fashion, able to take advantage of economies of scale. The trains will be electronic messages or files containing batched messages, starting and stopping at stations, i.e. computer servers at banks and other payment service providers all over the country. There may well be a grand central station, which most likely will be a central bank server, the Bank of England in the UK, or an overall NPA system operator, regulated and overseen by the central bank and central government. The FinTech magic in this is what will be taking place inside that central server and in all connected servers located right throughout the network. A plug-and-play payments platform. There's that word platform again. So, a payments platform with a middle layer of API sockets for participants who can plug into the system with their own front-end apps, accessing back-end services and probably able to utilize platform analytics services to boot. It's the 3 A's of apps, APIs and analytics again, a staple in the FinTech space. In many regards, this architecture characterizes the payment systems of tomorrow. Pure FinTech, finance and technology fused together. The example we just looked at, progressing from paper check to digital wallet to the payments platform, is an example of evolution within the PayTech area of FinTech. Earlier, we split traditional financial services along lines of PayTech, Capital Tech and InvestTech, and I would like to elaborate on that description to provide a fuller picture. Here is the definition I gave for FinTech, and an important word in that definition is enhance, because it suggests that FinTech is in essence about improving something that already exists. And this is true. But there is another term that crops up in the discussion of modern finance, and one I alluded to earlier. That term is TechFin, with the order of the syllables reversed. Some people do not make the distinction between FinTech and TechFin, but I believe it is worth doing so, at least when being introduced to this space, because doing so gives us a fuller appreciation of what constitutes modern finance. Though it is safe to say that you will not encounter any major problems if you simply bundle the lot into the term FinTech, as many choose to do. I define TechFin as follows. TechFin is the innovative use of technology to enable procedures for transferring, raising and investing money and capital. The definitions differ only in a single word, enable replacing enhance. The significance of this is to change the emphasis from the application of technology to improve something that already exists to the application of technology to create something that did not previously exist. In other words, it exists only because of technology. In financial services, the classic example of tech fin would be Bitcoin. Bitcoin, cryptocurrency in general, did not exist before the global financial crisis in 2007-2008, which is the point in time we often attribute to the birth of modern finance. Indeed, the global financial crisis was very likely the key motivating factor for Bitcoin's invention. A statement to say that if the established system could not be trusted, then people were going to build a new financial system by themselves. And it was a potent shot across the bow to demonstrate that people had indeed the capacity to do so. Whatever the rationale, Bitcoin was indeed an amazing technological breakthrough. There had been many attempts before to create a decentralized digital currency, but all had fallen short in one way or another. Ironically, none of the constituent technologies that make up Bitcoin are new. Cryptography, distributed ledger technology, consensus protocols, all already in use in one field or another. The brilliance of Bitcoin was in putting all of this together to produce something that actually worked. Trust was engineered by design. No central authority, no monopoly on power and influence. A clear first in financial services. It would be fair to say that it made the financial services establishment sit up and take notice. So, this is tech fin, and this is the reason I make the distinction. Bitcoin heralded in an entirely new field of finance, crypto finance. Thousands of cryptocurrencies, tokens, and their blockchains currently exist, and whilst we don't have time to go into cryptofin in any detail here, it is fair to say that it has found its way into all three strands of FinTech. Paytech, because Bitcoin was originally set up as a payment system rather than an attempt to replace fiat currency, as the name might suggest. Blockchain technology, the engine of Bitcoin, is now the backbone of novel ways to decentralize and democratize the raising of money. So it has found its way into capital tech too. Finally, Bitcoin and crypto generally is now a market commodity, a digital form of gold, invested in more for speculative purposes than for its use as a functioning payment system. And the underpinning distributed ledger technology is the basis for modern ICOs rather than traditional IPOs. Thus, it now features strongly in InvestTech also. Another example of TechFin is artificial intelligence, primarily in the form of machine learning. This has really taken hold in financial services, from robots giving better advice than financial advisors, to trading algorithms outperforming fund managers, to credit scoring algorithms proving highly effective at making successful lending decisions to people who traditional credit rating agencies refer to as subprime and would never recommend to lenders. Artificial intelligence, of course, is not an invention of the financial services industry, but its application has led to the creation of incredibly value-adding financial services that could not exist without it. In particular, in bringing lending and investment to millions of people who were simply not profitable enough to matter to the old system. This again is TechFin. Collectively, data science, artificial intelligence, machine learning, cryptography, distributed ledger technology, or its poster child blockchain, and consensus protocols are the engines driving the vehicle that is modern finance. Here I have categorized the tech fins as AI fin and crypto fin respectively. I mentioned how the birth of FinTech can be tied to the global financial crisis of 2007-2008. After the crash and the devastation it wreaked, it became clear that many challenges associated with regulation had contributed to it. Some regulation was not fit for purpose. Other aspects of regulation could not keep up with the pace of change. Yet other aspects were just not being implemented, and the lack of implementation was not actually being properly policed. Collectively, this allowed a financial system with its greed is good mentality to spin out of control. Now, the recent growth of FinTech, never mind the financial and economic complications arising from the COVID-19 global pandemic, has done nothing to ease the burden for regulators. In fact, the opposite. We saw earlier how much of the recent innovation taking place in modern finance is being led by tech companies. Tech companies are not subject to the same level of regulatory stringency as conventional financial services organisations, yet they are operating in the financial services arena. And the pace of change has only accelerated over the past decade or so. Therefore, a very considerable challenge for regulators is to design and develop regulatory structure and instruments that on one hand provide direction, guidance and coherence in how financial services should be provided, so that the producers of financial services and products have clarity, and consumers of these same services and products have confidence and trust in the system. The truly global and digital nature of FinTech presents additional challenges. For instance, there are no geographical borders in the operation of Bitcoin, an open, public, largely anonymous, unvetted network, which presents massive challenges in attempting to ensure that it is not being used for illegal purposes. Alas, there are clearly documented cases of precisely this. Think Silk Road and the dark web. At the same time, regulators want to make sure that any regulation put in place encourages and facilitates innovation and creativity rather than stifling it. So, regulatory innovation in FinTech will be big business, a fundamental and critical part of the industry now and likely to be for some time to come. These technologies often get referred to as RegTech. Next, we have the tech fins of artificial intelligence and crypto finance, driving change, innovating, reshaping, decentralizing, democratizing financial services. AI fin and crypto fin for short, these are the engines of modern finance. And by analogy, if these are the engines, then RegTech is the navigation system. And of course, to be roadworthy, any vehicle needs to be built on a sound and tried and tested structure. At the core of financial services, we identified the processes of transferring, raising and investing money and capital. Collectively, these form the chassis of traditional financial services, and their FinTech equivalents in PayTech, Capital Tech and InvestTech will serve that purpose in the tech age of finance. Building on what went before, bringing critical everyday financial services to literally billions of people who previously could not get a foothold on the ladder and were effectively closed out of the system through being underbanked or even unbanked. The FinTechs have brought ordinary people into the lending and borrowing arena and broadened accessibility to investment, the latter no longer the preserve of the wealthy and connected. And perhaps more critically, they are rewriting the book on how large companies access money and capital, ensuring that considerations such as carbon footprint and general environmental sustainability move to the top of the list of criteria for securing funding investment. So, putting all of this together, we have RegTech steering things, AI Fin and Crypto Fin driving things, and PayTech, Capital Tech and InvestTech supporting everything. This is modern finance.